This podcast brought to you by Ring. With Ring cameras, you can check on your pets to catch them in the act.
Izzy, drop that.
Or just keep them company.
Aw, I'll be home soon.
Make sure they're okay while you're away with Ring. Learn more at ring.com/pets.
Hey traders, welcome back to the Trading Coach Podcast. Today I got a cool episode for you. We're going to talk about 51 golden strategies, kind of. Now before we get started, I'm going to give you one bonus strategy, one that's going to help improve your trading right away, and that is to go back and watch the Beat the House free 4-day online trading workshop recordings, right? We did a workshop. It was 4 days of greatness. Recordings will be up until the end of August. Check them out. Link in the show notes. I promise you will come out a better and more informed trader than when you went in. So let's talk about these 51 golden strategies. And the title is a little bit misleading, and it's not my title. It is actually something I found on the internet. Now, I have no idea if this is true or not. I've done no research on it. I'm literally going through this list for the first time as I'm talking to you guys. It's kind of how I like to run the show, but it's a screenshot from that someone shared on Twitter. The paper or book looks old, so I'm assuming it is real and old, but it could be Photoshop. Anyway, I want to go through, I'm not going to read you each one, don't worry, but I want to go through and pick out some of the good stuff and some of the fluff, in my opinion. So let me just read through, and again, I'm not going to go through all of them, but I'm going to try to pick out ones that I think are either super good or super bad. And rule number 3, don't over trade, right? Over trading is something that a lot of traders do, especially newer traders. Why? Because we get bored, right? Back in episode 1011, right? Jason Greystone spoke to you guys about how newer traders are, well, I guess in general, people, we are ingrained that like we work for money. Like the more I work, the more money I get, right? When we go to a job, I remember as a youngin, when I used to work, I used to be excited about working more hours because I knew my paycheck would be bigger. And in trading, we assume it's the same way. If we are loading up a chart, if we are looking at a chart, analyzing a chart, we feel like I have to trade in order to get paid. And yes, that's true to a certain extent, but there's not necessarily the time for money trade-off that you think there is. In reality, the more you trade, the more likely you are to make mistakes if you're over trading, obviously. And then the more mistakes you make, the more money you're going to lose. So you're investing more time and effort and you're making less. So I like the rule, don't over trade. And over trading isn't a specific amount of trade. So like someone could take 50 trades and it could be not over trading if all of those trades met the rules of their trading plan. So over trading is taking trades that don't meet your trading rules. Let's go on. Never let profit turn into a loss. This is number 4. I don't believe in that either. And we got to be careful with how we define profit. Now, if you're defining profit as like your active trade being in the green, then this is completely false, because the fact of the matter is, like, the market ebbs and flows. There will be many trades where it goes up, it just doesn't go up enough to kind of meet your target, and then it goes down and stops you out. I told you guys a story about the 99% trader. This guy would, he wanted to win 90% of the time, and eventually he did, but he lost money when doing so. Why? Because he would never let profit turn into a loss. He would take profit off at like 2 pips, yet he would take his full losses. So his profit never covered his losses. Now, if we're talking about profit as far as like money in your account, or maybe profit where you're supposed to be out of a trade, but you get a little greedy and you want some more, you don't take it out, you kind of hold on, and maybe you don't move your stop loss to break even, then yes, I agree with it 100% there. But as far as like the idea of like, oh, I'm up 10 pips, I'm up $100, I have to get out because I don't want to turn into a loss, that is a negative trade. That is being afraid. That is a bad trade. You can risk manage if you want to kind of give yourself some safety. Number 5, trade with the trend. You know who you're talking to. Akil Stokes, counter trend trader. We're not going to get into it. False, right? The trend is not your friend, right? The trend is your friend until it ends, and it leaves you with none of your money, right? You could be a trend trader, you can be a counter trend trader, you can be very profitable doing both. Rule number 6, I better not go through all 51 of these. Gosh, I told you guys I'm reading this for the first time, so I was thinking like I'm going to pick out 10 and that's going to be it, but I just did like 4 in a row. But rule number 6, if you don't know what's going on, don't do anything. Yeah, I love that. When in doubt, stay out, right? We want to analyze the market. We only want to trade opportunities that meet the rules for our trading plan. And that means we know exactly what's going on in the market or exactly what we're seeing in the market in order to do that. If we are confused, if we ever have a question about something, if you're like, man, it looks like this, but I'm not really sure, when in doubt, stay out. I know it seems like you're going to be a scaredy cat, nanny boo-boo, right? But the truth is, right, good traders are great risk managers. If you're not in a trade, you can't lose money, right? You're avoiding a mistake, which is a positive. Winning trades will come, especially if the edge is on your favor. Tips don't make you any good money. Yeah, that's one from my stock days. Don't rely on tips. Always rely on your good analysis. That was rule number 7. Let's go down. Rule number 9. Don't be whimsical about closing out your trades. And I like this one, again, if it's rules based. And what I mean by that is, don't snort the hopium, right? The hopium is like if a trade is going against you, you hope that it turns around before you're stopped out. So maybe it's approaching your stop loss and you just, you kind of bang it down a little bit. And I'll just give it 5 more pips. I'll just give it 10 more ticks. I'll let it get like 15 cents more down, right? You keep moving away, hoping it reverses until it gets back to break even or put you in profit. This is something many of you guys are relating to this, right? I remember these days where it's like, I'm trying to even remember the feelings. I don't get it anymore. Trading has sucked the soul out of me, and I'm numb and dark on the inside, but very profitable in my pockets. But I remember just being in senses of panic. I would do this when I wanted to get revenge. I would do this when I did dumb stuff and I was losing money and I had to get a winner. When I had to get a winner, I would snort the hopium because it was all I had left. I was a loser. This was going to lose too. Like I just needed something, and I was literally crossing my fingers and praying that it would turn around. Not a great way to do it. And that's the same thing for targets as well. Again, it works on both sides, right? If you are up a lot, sometimes we tend to get greedy. We can be up, whatever amount, and we're supposed to be out of the trade, but it's like, oh man, I want to get more. I want to get more. I want to get more. I've been there as well. You got to trust yourself. You set up your trade the way you did for a reason. Your stops are where they're at for a reason. Your targets are where they're at for a reason. Trust your analysis. Trust yourself. Get out. You don't need to get all the profit. You just need to get the profit that you came for. Let's move on. Don't average your losses. Take big profits and small losses. That's a good one. Take big profits and small losses. Again, it depends on your risk reward. If you're a very, very, very high percentage trader, you can actually take smaller profits and bigger losses. You can have an inverse risk reward ratio and still be profitable. But most traders aren't going to win more than like 50-something% of the time, right? So most traders need to make more on their wins than what they lose on their losses. Always a good sign to take big profits and small losses. Again, just make sure they fit within the plan. We're not taking big reckless profits where we're just closing our eyes and picking someplace because it's big. We're not using small unsafe stop losses just because it's small, right? These are big profits, small losses within our trading rules. Go on a long pull out speculator, sell short as often as you go long. Don't buy something because it's low priced. That's a good one for stocks as well. I'm trying to read through and get to some good ones. Don't formulate new opinions during a trade. I like that. Watching a trade is probably the worst thing you can do. Now, there are some methods if you're doing an active trade management where you may be managing on a candle by candle basis, meaning if you get a negative candle or if price holds at a certain point, that is a reason to exit the trade or adjust your trade somehow. But in general, what this is pertaining to is typically you're in a trade, you're watching it, and you're freaking out, you're panicking because you're in that highly de-stressed state. And now all of a sudden your mind is wondering because, oh my gosh, if Akil said if it wins, it should win right away. I never said that. I think that is something I've heard someone say, but just kind of, taking you through your mental dialogue. It's not winning yet. That means it's going to lose. It's going to do this. It's going to do that. News is coming out. And your head explodes, right? You're not making rational decisions. You're making panic decisions. So do all your analysis, cross your T's, dot your I's before you take the trade. Once you're in the trade, set it, forget it, only follow the rules. Don't follow the crowd because they're usually wrong. Rule number 20. Yes, getting halfway through. Don't watch or trade too many markets at once. This is rule number 21. And this is an interesting one. I told you guys we just had that workshop. And in the workshop, Jason and myself mentioned that we're mainly Forex traders. Now, we invest in other markets, but more of an investor type, right? And the question that we often get is like, how come you guys chose the Forex market or only focus on the Forex market? How come you guys don't trade stocks? And the answer is simple. I've been doing the Forex market for what, 17 years now, 16 years, somewhere around there. And I've gotten really good at it. I know it really well. There's a certain portfolio, meaning certain pairs that I follow. I know that it's like a relationship. The longer we've been in a relationship, I know your ins and outs. I know what makes you tick. I know what gets you mad, right? I know how to touch you the right way. Could I go to the stock market? Yes. But it would be a relearning. Now, the basic principles of technical analysis are the same, but I don't have that relationship with the individual stocks when it comes to that trading perspective. Remember, trading is short term. So it's like, if I'm doing good in one thing, I'm making good money in one thing, is there a reason to go to another thing? And if I go to that other thing, would it negatively affect the thing that I'm really, really, really good at? I don't want to overstretch myself. So it's kind of, if it ain't broke, don't fix it type of deal. So I like that. There's nothing wrong with expanding, don't get me wrong, but you just got to be honest with yourself. Let's keep going on. Preserve your capital. Yes. Here we go. Rule number 26. Nothing new ever occurs in the markets. Now, yes, this is 100% true. The markets have been moving the same way forever. Fun fact, the markets have been putting in the same classic pattern formations, the same price action pattern formations, even before we had charts. So think about it like this. The head and shoulders, the Gartley patterns, the double tops, the double bottoms, the flags, the pennants, the wedges, the breakouts, right? All of that fun stuff, that has been happening before we could even see what it was doing. And it's because price action is based off of human behavior. Humans, for better or for worse, usually worse, we're pretty predictable, and we've been the same way since the beginning. Now, there was a time where something new happened, and that was called the Trump era. And I call it the Trump era because of this. This was the first time when Trump got elected. The first time, I guess he didn't get elected the second time yet, maybe? I don't know. Let's not get into politics. The first time he got elected, he was the first president that was kind of very active on social media. So, Trump was on, like usually presidents, they don't say anything. They're just like, they go through their people and their PR person makes them say a bunch of something that doesn't mean anything, and you got to be very careful. Trump would go on Twitter and be like, yeah, interest rates are too low for the dollar. We got to change that. And like the market would go crazy. So that was the only weird era that we had. It was called the Trump era, where something new was introduced, because not only did you have to pay attention to like the normal standard news events that would come out, I had to have Twitter open in a side screen, making sure this guy didn't say anything and wondering why the markets are moving. We'd be in the middle of a day and like a big red candle would be coming out. I'd be like, Jason, what's happening? And he'd be like, you're president. I said, what do you mean? He said, yeah, he just came out and said that, Jerome Powell is wrong. We need to cut these things. I'm like, what? So that was the one new thing that happened. But aside from that, the market does the same old stuff. SOS, right? Rule number 27, money cannot be made every day from the markets. It can be made every day from the markets, but I think what this means is you shouldn't expect to make money every day. You don't have to make money every day. There are going to be no trade days. There are going to be losing trade days. We talked about this in the workshop where, I don't know if I'm going to win trade by trade, day by day, week by week, month by month. But the longer the duration goes out, the more your edge plays out, right? The law of large numbers. So yeah, market, you don't have to make money. You won't make money probably in the markets every day. And that is 100% true. Rule number 29, markets are never wrong. Opinions often are. Yeah, market doesn't care what you think. It's going to do what it wants when it wants to. I forgot the saying, but the markets could stay irrational longer than you can stay rational. It's a better version of that. But the markets will do what they want for any rhyme or reason. Just because you think something, or just because the market is supposed to do something based on like classical principles, doesn't mean it's going to happen. Trump can hit you with a tweet or an X-bomb, and then boom, everything blows up. So you never know. Rule number 30, this is one I don't like. A good trade is profitable right from the start. Not true. Markets do not have to move in your direction right away. They can easily go down some before they go up, or go opposed to you before they go up. 100% not true. I think all that mindset will only lead to panic. You don't have to win right away. When you organize a chart, and imagine, since we're not on camera here, imagine this. Imagine you have there's 3 lines, right? The middle line is your entry. The line above is your target profit, your exit with profit. The line below is your stop for loss, right? What you're doing as a trader is, when you enter that trade, right, you're not saying the market has to go right, it has to go in your direction right away. If you did, your stop loss would be a pip below or a tick below your entry, right? Because if it went any against you, you would be wrong, and you want to be out the trade as quickly as possible. What you're doing is, you're saying that when I enter at this area, price is, I'm assuming, I'm betting on, price is more likely to go to my upper line, my target, before it goes to the lower line. And that's very important to understand. It is not a right away thing. It's likely to go, it's not even it's likely to go here. It's likely to go here before it goes there. And that is our trade setup. And that's why smart stops are so important. As long as the market is acting right, don't rush to take profits. Acting right, I don't know. It's probably a trend thing. We're going to skip over that. Let's go down and find some. I don't like this one. Rule 33. Don't try to predetermine your profits. Wrong. You should predetermine your profits. But it seems like these are old golden rules. This kind of goes based off the one that said don't go against the trend, right? Based off this thinking that the trend is your friend, you want to ride it until it ends. It makes sense in that perspective, but that's not a realistic one. You should predetermine your profits. If you don't predetermine your profits, you don't know your risk profile. And again, you're never going to catch bottoms all the way to tops. You want to get out at where you expect the market to get out at. You don't want to be greedy. So completely disagree with that one. Become a buyer as soon as the stock market has new highs. Nope. Human side, every person. Here we go. Look, rule number 36. We're getting there. Sorry, it's a long one. The human side of every person is the greatest enemy to successful trading. Amen. Can I get shout out from the back? Can I get an amen? Amen. Right? That reminded me of the old. If you guys are Eminem followers, Slim Shady. Amen. And the creepy, what's it, Ken Kniff? Anyway, dating myself. Yeah. This is trading psychology. They might as well just put the rule in there. Trading psychology, don't listen to yourself, listen to your analysis. So yeah, 100% true. This list is starting to win my approval back. Oh, let's go to number 37. Follow up on that. Ban wishful thinking in the markets. Amen. We got another one, right? 2 in a row. Yep. Ain't no wishful thinking, right? Follow your plan. Be robotic. Don't wish, don't snort the hopium. Big moves take time to develop. Rule number 38. That's 3 in a row. Tic-tac-toe. Here we go. The rhymes there. Here's another one. Here's an interesting one. Don't be too curious about the reasons behind the moves. And I like it, but I don't like it. I think we should be curious about it. I think curiosity allows us to understand what's going on, why it happened, especially if it's a news event or news related. Because that's more information that we have, and the more information that we have, the better we can use that for the future. So I do think you want to be curious about the reasons behind the moves, but I agree with it in the fact in that we don't need to overthink. Again, going back to whatever number it was, like the markets will do whatever they want. So if you get stopped out of a trade and it's like, oh man, why did it fail here? Because it just failed. Sometimes there's no reason. It does it. It didn't hold. It didn't work this time, right? That's just how it goes, right? Like sometimes Steph Curry just misses a 3-pointer because he can't make them all, right? It just happens. So that's an interesting one. I like it in kind of both ways. Look for reasonable profits. Number 40, I feel like that contradicts the other one that says don't predetermine profits, right? See, now we're getting here. Let's go. If you can't make money trading the leading issues, nope. I'm trying to skip down to another good one. We're almost at the end, guys. Hang on for a little bit more. Trade active stocks and futures. This is a good one. You're not going to see this too much in Forex trading, but in the stock market, you need volatility, right? So if you're trading a dead stock, you're going to get a dead result, right? For example, when I used to trade Microsoft or invest in Microsoft. Microsoft at the time was a good stock, but it was a dead stock because it's just slowly, steadily kind of does nothing. It gains over time, but from a trading perspective, it doesn't really fluctuate too much. Forex specific, this would be like the euro pound. We call that the molasses because it just moves like a sloth, right? By the way, learned a little bit about sloths the other day, and they spend 90% of their life upside down, right? At the beginning of my trading career, I spent 90% of my time in the red. So, hey, me and sloths had something in common. But yeah, you need volatility, right? So you need movement for, right? If price, go back to the 3 lines, right? Entry, stops, targets, right? If your targets are above your entry and you need price to go there, price is not going to go there if it doesn't move. So you need things to move. So yeah, don't trade dead stocks. You do need active stocks, and for Forex as well. Rule number 46, the smarter you are, the longer it takes. We've gone over this before with the smart trader, the overly smart trader. I think people that are super duper smart and not used to being wrong struggle because they don't know how to adjust and adapt and dealing with the fact that, again, you can do everything right and still be wrong in trading. So I think it takes them longer to adapt. Dumb people, there is a point where you can be so dumb, but typically like normal intelligence people, we're used to being wrong and then learning while we're wrong and adjusting and accepting it. And we do a much better job of that type of stuff. It's harder to get out of a trade than it is to get in. Nope. Don't talk about what you're, I like this. Here it goes. Number 48. Listen to this, you social people out there, right? Don't talk about what you're doing in the markets. Yeah, shut up. No one cares about your trade. No one cares how much you made or lost on your trade. Stop telling people about it. Stop telling people you're long to euro, because newer traders that may or may not have been in a chat room for a very long time and afraid to type anything and then finally get the courage to type something in saying they're short the euro don't want to hear that you're long the euro, because they may exit their trade because of what you said, and that trade may end up going in their direction, and then they get mad that they missed profits all because they listened to someone on social. That's a story I heard from a friend of mine named Akil Lokes. Yeah. But yeah, don't talk about it. I'm superstitious as well, so I believe that the markets will do the opposite of whatever I do. So if you notice, for you guys that have been with me trading live, right, I don't look at trades when I'm in them live. I don't want to talk about them, because if I say, hey man, this trade's looking good, as soon as the market hears that, it's going to go south, right? So I just, superstition, I don't talk about it, just, let it be. Control what you can, manage what you can't. Yeah, control what you can control. I like that. That's number 50. So we got one more going for it. Control what you can, manage what you cannot. I like that in the sense of drawdowns. Drawdowns are going to happen. We've done a lot of risk management lately, and I got some really cool podcasts coming out about that. And there's sometimes nothing we can do about them. Now, if they're a self-inflicted drawdown, yeah, we can stop that by stopping the dumb stuff, right? But sometimes your trading strategy just sucks, right? It doesn't work. And the thing is, a lot of us try to make up for that, and we try to think we can control that, and we start doing different stuff, and that different stuff just gets us in more trouble, and we dig ourselves into that drawdown hole, right? We're struggling and panicking in quicksand, and that just makes us sink quicker. We can't control it. Just be sure to manage it. Manage yourself, right? Don't make a regular drawdown and extended drawdown. Manage your trades, right? Manage your risk. Make sure you're putting yourself in the best case scenario to lose as little as possible until this kind of nasty period clears and you're back to business. Number 51. You don't need, I didn't even read it yet, but I'm just going to read it because it's the last one. You don't need brilliance to make money in stocks. Oh, yes, this is good. This worked out perfect. You don't need brilliance to make money in stocks. You need discipline and patience. One more time, amen. There you go. 51 golden strategies. They're not actually strategies, but rules, tips. Some I like, some I don't like. If you have any opinion on any of the ones that I chose, feel free to type it in. And what I'll do is, I don't know if I can share it. I'll share the full document thing or Twitter thing in the show notes. That way you can check out all 51 if you have nothing better to do with your time. I have something better to do with my time, so I'm out. Okay, I lied. I'm not out yet. Before I go, do me a favor, leave this podcast a rating and a review. It's the best way to grow this podcast. I just got an email the other day from good pods or something like that, saying that we're bumped up into the top 50 or something like that in the investing category. I don't know what it means, but it's cool. It's an arrow that said we're going up, so that's positive. I like it, right? So leave me a rating, leave me a review. It's the best way you can support the show. I can keep getting emails with more green arrows, and we can keep reaching more traders and having more great conversations. All right, go on for real this time. See ya.